has been and will continue to be a flight to safety asset for the foreseeable future. It doesn't mean Bitcoin won't be. We saw what happened back in Silicon Valley bank stresses. We don't know what happens if the market falls apart. Like, why did it fall apart? What was the issue? What was the black swan? Well, that's going to determine what Bitcoin does. Most likely, Bitcoin draws down along with everything else. That's the most likely scenario. If we have something like this occur again and you get stresses in the system. But on the backside of it, you're also going to get this and a whole lot more of it than that on the backside of, which means that gold and Bitcoin will rip higher off of it. That's just reality because the expansion of the money supply and expansion of liquidity. So that's kind of a top line overview of that.
As liquidity tightens and the Fed approaches a crucial pivot, Bitcoin is once again emerging as a frontline hedge against a potential monetary storm. Bitcoin surged 3.7% to $111,000, signaling growing investor anticipation of a potential shift in U.S. monetary policy. James Lavish, a former hedge fund manager and macro investor, warns that the financial system is nearing a critical liquidity threshold. Bank reserves have slipped below 10% of GDP, the level Jerome Powell and the Federal Reserve often describe as ample. This mirrors the warning signs of 2019, when overnight rates spiked from near 0 to 7 to 8%, forcing the Fed to pivot from quantitative tightening (QT) to quantitative easing (QE) even before the COVID shock. Today, a widening 20 basis point spread between SOFR and the effective Fed funds rate reflects rising funding stress. Lavish believes the Fed may soon halt QT to prevent another liquidity crunch. Such a policy shift could fuel risk assets, particularly Bitcoin, as markets anticipate renewed liquidity expansion. Early October saw both Bitcoin and gold rising in what analysts call the debasement trade, a hedge against weakening fiat currencies. While gold has held its breakout, Bitcoin briefly touched $126,000 before pulling back, highlighting its volatility. Still, if the Fed pivots, Bitcoin could be among the biggest beneficiaries of a new wave of liquidity. If you found this insight valuable, drop your thoughts in the comments, share it with fellow investors, and hit subscribe to stay ahead of Bitcoin's next big move.
We're getting to a point where do we have ample bank reserves, which is a word that the Fed likes to use. Powell likes to use it specifically. Do we have ample bank reserves to have enough liquidity in the system that we don't have something break like 2019? We've talked about 2019 before. It's often overlooked. People just ignore it. Most likely because we had that massive event right afterwards called COVID. And so, but in the fall of 2019, you guys can see it easy. You see it?
Go ahead. Yep.
Okay. So, what happened is you've got the bank reserves that have drawn down. I think they ticked up over the weekend, but they drew down to under $3 trillion. Why is that significant? Well, it's significant because, the Fed is looking at what is ample in bank reserves. If you look at GDP, this is kind of their measuring stick. And they said they want to stay somewhere around 10% of GDP as ample, and if it drops below that, it's no longer ample. It may be sufficient, but it may not be. Well, this is what happened in 2019. You can see the bank reserves drawing down. What was going on here? We were doing QT. We were doing QT after the massive print of 2008. And that was continuing through. And we were, the Fed was selling bonds off its balance sheet. And then suddenly we get we have where we get below 10% of GDP. We're down about 7% of GDP. So this blue line is 10% of GDP. This white line is the bank reserves. And so we got below that and it froze up, and we turned around and literally overnight we started doing QE again. So this is before the stressing of the system. This is where you got the bank reserves below 10%, and then boom, we get QE. This is before COVID. This is the significant part. This is at the end of 2019 that we're doing QE before we even get to the crazy levels of QE of this, which is what everybody talks about, this $5 trillion. But we were doing QE beforehand. So where are we now? Well, we're back at that spot where we're below 10% GDP. And that's where you're starting to hear Fed officials saying we may or may not have ample reserves right now, which means that QT is effectively done. You know, it's only $25 billion a month right now, but it's still significant enough where it's, you know, $250 billion a year or more, $300 trillion a year. So that's where when do we pivot though? Well, we're looking at things like the SOFR rate minus effective Fed funds, meaning what's the spread between what's effectively LIBOR, what banks lend to each other, versus what the Fed funds effective rate is. You know, financial institutions lending to each other versus what the banks will lend to each other, basically overnight, unsecured. But this is the SOFR. This is what's so important. This SOFR rate is a secured overnight financing rate. That's where banks are using their treasuries as collateral to borrow from other banks or other financial institutions. Hedge funds use this. They'll dump their treasuries overnight if they need some capital to make margin calls or whatever. They'll do that, and this is what they pay, the SOFR rate. Well, it's jumping up over the Fed funds rate, where they should stay pretty much right on top of each other, just within a few basis points. Well, now they're almost 20 basis points, which means that there's beginning to get stress in the system. Is it DEFCON 1, DEFCON 4? No, it's somewhere around DEFCON 2, where it's like, hey, this is significant enough that you ought to be paying attention to it, because look at how noisy it's getting and how it is gravitating upwards. That effective rate spread is gravitating upwards. Have we had something break it? No, we haven't. But it literally happened overnight in 2019 that we had stresses in the system that caused this. Well, it was tax payments. It was the need for capital overseas. It was the dollar. It was like, there was a few things. And then it was, of course, the Fed, or the Treasury, coming out with an unexpected need for issuing treasuries and need for more dollars, basically. And so the spreads blew out. And that just means that they turn around overnight. They literally turned around overnight and started doing QE. This is what happened that day. It went from just about 1% of the overnight repo rate to, about 7%. And it happened so quickly. And that's what we're looking for. We just got to be aware of that. And that's what the Fed is aware of. So I think they're going to stop QT pretty imminently.
As fear grips the crypto market and liquidity stress builds beneath the surface, Bitcoin stands at the crossroads of panic and opportunity. October's optimism in the crypto market has sharply flipped to fear. The total market cap now hovers near $3.6 trillion, with 24-hour volume surging, a classic signal of forced selling rather than steady accumulation. Sentiment is fragile, with the crypto fear and greed index sliding toward extreme fear, feeding a self-reinforcing crash narrative. Against this backdrop, James Lavish warns that the Federal Reserve may be forced to pivot to QE either suddenly if liquidity stress intensifies or gradually through a new easing program to calm markets. Lavish notes that while many expect quick resolutions, policy shifts typically unfold over weeks or months. Gold, he argues, is already acting as a safe haven, while Bitcoin may initially fall with risk assets in a liquidity squeeze. However, once liquidity expands, Bitcoin could surge strongly alongside gold. He also points out that the Fed's standing repo facility can only delay, not fix, the underlying reserve shortage. Adding fuel to the pressure, core inflation remains stubborn at 3.1%, reinforcing expectations of ongoing monetary debasement. With central banks favoring gold over treasuries, Bitcoin is increasingly positioned as a modern hedge against inflation and liquidity-driven volatility. Let's get back to the interview.
When do they pivot to QE? Well, if something like this happens, or they just start easing into it somehow with some sort of acronym to avoid something like this. And that's what we're looking for. When it happens is, what I don't like about Twitter is everybody is on this timeline of minutes to hours of expected outcomes. Like, look, the guys on the screen here have been doing this for like 3 decades. We've been doing this for so long that a week, 2 weeks, 3 months is not like, that's nothing to it. Like that's a normal, timeline for us. Is it going to happen tomorrow? No, I don't think it's imminent, but it could. And you just have to be aware of it. That's just something to be aware of. And if you think gold is not sniffing this out, you're not paying attention. Of course, gold is sniffing this out. This has been and will continue to be a flight to safety asset for the foreseeable future. That doesn't mean Bitcoin won't be. We saw what happened back in Silicon Valley Bank stresses. We don't know what happens if the market falls apart. Like, why did it fall apart? What was the issue? What was the black swan? Well, that's going to determine what Bitcoin does. Most likely, Bitcoin draws down along with everything else. That's the most likely scenario. If we have something like this occur again and you get stresses in the system. But on the backside of it, you're also going to get this and a whole lot more of it than that on the backside of, which means that gold and Bitcoin will rip higher off of it. That's just reality because the expansion of the money supply and expansion of liquidity. So that's kind of a top line overview of that. Oh, and one other thing. So people are saying that, yeah, but you've got the standing repo facility. You've got the standing repo facility that solves this. It doesn't solve it. It may extend it. It may soften it overnight. You may not have this happen overnight, but this could happen gradually over time because it doesn't solve the problem. And I'd love to hear Mike's thoughts on that and all of it, because he's been in credit and debt for his, the bulk of his career. And this is just kind of what I see from my viewpoint. I mean, let's face it. This has been delayed. The CPI has been delayed. What you're looking at here is the CPI, and you've got the core services and you've got the core goods, inflation. But what we're looking at here is this is the white line. This is the core CPI reading. This is expected to just continue higher here at 3.1%. Okay, so inflation's not stopping, and the world is figuring this out in real time, that this is not stopping, and we're going to continue to stoke the flames of inflation. That's just reality. This is not. So this is what people need to understand. Even though we're not getting this, we were supposed to get this, 10 days ago, Mike, something like that. We're now getting it this week, even though there's a government shutdown. It's delayed. How strong this number is, I don't know, but this is a really important factor into everything we're talking about, along with, the denominator just continues to go higher. This is what's driving the denominator. Inflation is kind of a reflecting the expansion of liquidity and money supply. This is like an indication of what's going on. And it's important to realize that this is continuing. It's not going to stop. And gold has figured this out. And meaning central banks don't want I don't know. I think, Dave, you said this at the beginning of the show, is that central banks don't want to hold dollars. Well, they really don't want to hold treasuries because, they need dollars eventually to do trade, most of them. And because the dollar is the global reserve currency, but they're using gold in lieu of treasuries because of this, because they don't want to be holding something that's a negative real yield. And that's the real crux of all of it. Okay. And this goes back to Mike's assertion that he thinks rates on the 10-year and the 20-year and 30-year are coming down. And they could short term, but long term, I think you have what we've been talking about, the bond vigilantes they're standing there and they're refusing to accept lower rates because they want rate premiums to pay for the likely expansion of liquidity, money supply, and continued relentless, perpetual structural inflation.
As liquidity tightens and funding stress builds, Bitcoin stands at a critical turning point in the broader macro landscape. A potential end to QT signals the return of a more accommodative monetary stance, a catalyst that has historically fueled strong rallies in hard assets. While short-term volatility may shake out weaker hands, expanding liquidity tends to favor assets with scarcity and global demand. Bitcoin's track record as a beneficiary of monetary easing positions it to capture this momentum once policy shifts become clear. In an environment defined by structural inflation, reserve pressures, and easing expectations, Bitcoin could emerge as one of the primary winners of the next liquidity wave, reinforcing its role as a modern hedge against monetary debasement. Do you think a potential Fed pivot from QT to QE could spark the next major Bitcoin rally? Share your thoughts in the comments, spread this with fellow investors, and subscribe to stay updated on Bitcoin's next big move.